So, spotlight. It's going a bit longer than I thought. Okay, spotlight. Not a hugely long one, and actually not an accounting. It is accounting related, but it's related to the stuff that we're doing today. What the spotlight is on stock option backdating. And this was a practice which a lot of companies in the US were practicing. It wasn't technically illegal. They're allowed to do what they were doing, but it was kind of sneaky. It just meant some of their execs were probably getting a little bit more money than what they would have otherwise been getting. And look, these are the sort of things, if you know how the rules work, if you know how the accounting rules work, if you know how just laws work, you can either use it for good and try to figure out how to stop people, manipulating things and doing things they probably shouldn't. You could use it for bad and actually take advantage of them yourself. It's up to you. Stock option backdating was a practice over in the US. Quite a few companies were doing it. It was actually picked up by an accounting professor out of NYU. And it got a lot of traction, and a lot of people got really interested in it. And it changed, because of what he found, it changed the regulation. They actually had to, because what they found was very much not coincidence. So the issue was, and I don't know how many people are doing finance or not doing finance, but just the really, really ballpark discussion of options. It's not the only thing which the way you work out the value of an option, but the big thing which you get how to derive the value of an option is the difference between the share price and the exercise price. I mean, you also, if you know the Black-Scholes model, there's also volatility and time to expiration and a whole range of other things. But the share price and exercise price are what we're looking at, and is what's important here. So, the larger the difference, the more that it's worth. So if you've got a call option, so if you have a call option with an exercise price of $10, it means if you hold that, you can buy shares for $10. Now, if the share price is only $2, you're not going to exercise that option. The option is pretty much worthless because you'll just buy them on the market for $2 rather than exercising the option. However, if the market price is $14, you can make $4 off that. And if the option was exercisable right now, because you could exercise it, buy one for 10, sell it for 14, and you made $4. Now, the issue is, for all intents and purposes, market price, at least not easily, market price cannot be adjusted or manipulated. In reality, of course it can, but it's pretty difficult to do that, and it's you've got to do things in a big way to make that happen. But the exercise price is based on the date the option was granted. So if I can, what's your name? Anthony. Anthony. So what could happen is a company, and this is Trident was one of the companies that I think was involved in this. Trident could, as Anthony's the executive of Trident, we give you, as part of your compensation package, give you shares, give you options. Now, you get them on, say yesterday, on the 12th. Now, you do actually get them on the 12th. However, in terms of, this is where the sort of backdating happened. They went, hang on, we're not going to give them to you on the 12th. We're going to say you receive them, and they then look back over a window of time over the last 30 days or so and go, when was the lowest point in time in which the share price was? Because that means that's the exercise price. And if we can keep that exercise price down a little bit, even if it's 50 cents, if you're getting a couple of thousand options, that's going to just give you that little buffer of extra profit down the line. And so they'd actually try to look back over time to figure out when was the lowest point in time in recent history that they could do these. Now, it could be coincidence, but what they found was, and this is a later study when they looked at it, when they looked at nearly 2,000 companies, it just was almost too perfect. Like pretty much every time an option got given, there was a drop in the share price to when that option was granted, and then it just spiked afterwards. And it just was something which was too repetitive and just too often to say this is just a coincidence. Yeah, some of them probably were coincidences. But what it looked like, and it ended up coming out that was the case, is they were looking back, picking the low point, making the option granted at that point, low exercise price. It means you just get a little bit of a bump when you actually exercise them. options in themselves are a good thing. You don't want to restrict them doing that. So what the regulation changed was it limited the number of days you had before you had to report that you issued options to your executives. So instead of being the 30 or so days, it would be like 1 or 2 days. So it just meant that they couldn't kind of give you an option, then figure out a day which was best for you. And that's, look, it's not an accounting thing per se, but it's you know, it's just one of those things which was neat to talk about. At least I thought it was neat to talk about. So, share-based payments. Really quickly on this, and I know because you guys talked about it last week, so there's only one little bit I want to talk about in share-based payments. And it comes in your debit assets or expenses. That's we're not worried about. If it's credit equity, if it's equity settled, credit liability, if it's cash settled, at this point in time, you should know why that is. That topic could well be in the exam. You should be comfortable as to why the difference between those two and also why there is a difference. We're going to focus on equity settled. Now, how to account for it, and we're not going to go into the details of that, depend on if they vest immediately or not, or at least the technical details. If they're time-based, it means when you receive those options, you can't exercise them straight away. You might have to stay at the company for 3 years before you can exercise them. And that makes a lot of sense from an incentive point of view because, again, give Anthony some options. The basis of those options being valuable to you is if the company does well and the share price goes up and you get to exercise them later. But if you get them and then disappear off and still are able to exercise those options, you get a benefit of the company doing well when you've left. So what they do is they try to, I suppose, by having a 3-year vesting period, it kind of forces you in a way to stay because if you leave, you're going to lose all that potential upside if the company does well. Performance-based, same sort of idea, but instead of being you have to stay around for a certain number of years, you can only exercise them if a share price hits a certain point. And often they're tied together, so you've got to stay for a certain amount of time and the share price has to hit a certain point. So it's all just playing around with incentives and how to sort of get people to work hard, I suppose. How much is recognized? With equity settled, you use the fair value of goods or services. Now, for employees, that's difficult because often employees will also be getting a cash package as part of it. They're not generally going to be only paid equity. In some cases, some .com companies, yes, that can happen. But generally, you're going to be getting a package of shares plus cash plus other things. But even saying that, how do you measure the fair value of the services provided? I don't know. I mean, maybe there's a way to do that, but in realistic terms, that's quite difficult. So for most employees, employee share-based payments, you're going to use the fair value of the equity. So if I give Anthony some shares or Trident or whichever company gives Anthony some options or some share-based payments, the expense for that is going to be based on the value or the equity component is going to be based on the fair value of the equity instruments provided. So that's where if we just give shares, you figure out what the fair value of those shares are and put that number in. If it's an option, then we need to work out some fair value option pricing. So whether it be Black-Scholes, binomial, it's a long time since I've looked at finance stuff. But if you use an option pricing model, look, and those aren't perfect, but that's what you've got to do. Unless maybe the options are out in the market and those particular options are traded, then you can use those fair values. Otherwise, you've got to calculate something. And we're done. So we covered the definition of a liability. We linked the treatment of employee benefits with that definition, and then we looked at the accounting for employee benefits. Next week, as Rob mentioned at the start, look, yes, those readings, but those readings probably can get done after the exam. So next week at 11 o'clock to 1 o'clock, look, I mean, I'll probably be there till 1 o'clock. So 11 o'clock to 1 o'clock, I'll be in the lecture hall. I'll be there just kicking around if you guys want to have a chat. 6 o'clock to 8 o'clock, I'll be here next week if you guys want to have a chat. Most tutorials, some tutorials are going to be cancelled, and we'll put up announcements about that. The 8 o'clock class is definitely being cancelled because realistically, I don't think anyone's going to come in just for 8 o'clock to have a chat. So look, the thing is, if someone's here at 8 and is still wanting to have a chat, I'm happy to stick around, but we're not going to have the 8 o'clock class running. Some of the mid-afternoon classes will be cancelled, but there will always be a class on at a particular time. So just keep an eye out on those announcements. I'll be putting together a video for foreign currency. Now, just the rationale why we want to still cover current foreign currency is a lot of financial instruments, a lot of hedging, we're dealing with foreign currency hedges and dealing with those sort of situations. And to do that properly, you need to know the foreign currency accounting. Foreign currency accounting is pretty straightforward, but there's still enough in there that it would just make that first week back way too big. So I'm going to put something together. It is probably going to be about half an hour long, maybe not even that, but it's not going to be super onerous. I'll put that up online. Have a look at that when you feel like it. And other than that, if you've got questions, UTS Online, come down and talk to me now. Have a good Friday night, as much as you can after an ASR lecture. Of course you can. It's just a perfect way to get going for a night on the town. Have a good weekend, and I'll see you guys or some of you, maybe, possibly next week.